Hello and welcome to the latest Insider interview. Our guest today is Michael Matthews, the manager of the Invesco Sterling Bond Fund. Michael, thanks very much for coming into the studio.
Morning.
The past 5 years have been very difficult for bond investors. Your fund is up 6% ahead of peers, but only up 6% over this period of high inflation. So what's gone wrong for bonds over this difficult period?
I guess the last 5 years isn't the most flattering period for fixed income returns. When I look back from my career, for the first, I'd say best part of the first 30 years, it was a very bond friendly. We had risk off periods, but it was a very bond friendly environment. But the last 5 years, if you think back to the starting point, I could guess it was around kind of just post COVID. You think back to what the bond environment was like then. You had zero interest rates, you had negative yield in places, you had governments doing QE, corporate investment grade bond yields, probably were yields of 1.3, 1.5 at the all-time lows. And then in the last 5 years, it's a completely different environment. As you said, inflation has been a lot higher. Central banks have had to tighten policy a lot higher, further than kind of anyone thought back those 5 years ago. We now have QT rather than QE. We had the Liz Truss mini budget, we had the LDI sell-off, and we're in just this completely different rate environment. If you think, 2022, I think gilt index was down 25%. So as soon as you're including that sort of year in any 5-year period, it makes it a pretty unattractive backdrop or kind of an outcome. But I think looking forward, I think it's a much better place to be. It was a bit frustrating as a bond fund manager when we had yields of 1-2%. It's like, how can an active fund manager really add much in the way of added value? And everyone just focused on your kind of the fee versus the yield because it was a big component. But now we've got yields a lot higher. But when you've got the gilt yields in the 4 to 5.25 type yields, you add on a credit spread, you add a bit of duration as well, and you're getting some pretty good quality companies that are paying you yields of 5.5 to 6.5. I think it's a much better backdrop looking forward. But looking back, the last 5 years have been challenging for fixed income returns.
So is today a better time to be investing in fixed income?
So it's interesting because central banks have been cutting rates, albeit small and gradually, but whether you're looking in the US, Europe or in the UK, central banks are cutting rates, which would normally be a kind of favourable backdrop for bond returns. But there's two other components. One is there's a lot of issuance that the governments are doing, so people are worried about the supply. Inflation is probably been stickier than people thought and are worried that central banks probably can't do that much more in terms of loosening policy. But the other thing is credit spreads are quite tight. So whilst we talk about kind of bond returns having not been that good over the last 5 years, actually in terms of credit spreads, we're at close to post-GFC tights in most areas of the market. So for us, kind of looking forward, probably having some duration risk in the portfolio is maybe slightly better risk reward than necessarily going too far down the credit risk spectrum.
What's your view on interest rates in the UK? And by the end of this year, where could interest rates be?
I'm not sure we necessarily think interest rates are going to come down aggressively. In terms of central bank policy, I think the market's pricing in 2 cuts. Another one in May and one in August that will take us down to 4% in the UK. There are some commentators that think actually probably it'll be difficult for the Bank of England to cut again because wage inflation's sticky, and with the Trump tariff threats, inflation could be picking up. Our own desk economist, he's still bearish on the UK and thinks we could have 100 basis points of cuts. I think for us, we probably do have a bit more duration than the peers. Our duration in the portfolio is about 6.2. The index is about 6, so we're slightly long. But I think we are still very aware there is a lot of issuance to come. When you've got I don't know, $1 trillion of gilts to fund over the next few years, you do worry about the supply. But what we do think is, as I mentioned, when you've got a yield of 5.25 at 30-year, if you add on a 150 credit spread, you can get to what historically you'd be thinking would be a yield that you'd be getting on a much kind of riskier asset, whether it's been the AT1 market or high yield market. So you have to, rate volatility has been an issue. You have to live with that volatility. I think it's very difficult to be sitting here saying duration or interest rate risk is very cheap. If equity risk, or the equity volatility that we've seen of late with the Trump tariffs, if that starts to be a bigger thing and equities start to sell off more and people start to be worried about risk, maybe government bonds and interest rate risk could give portfolios this nice diversification, where you'll have probably them going up in price to offset kind of the equity price falls. So I think we are a bit long duration versus peers, not massively so, but because unlike the last 5 years when yields were really so low, we now think actually they may not be getting cut, but at least they're giving you a nice income and a kind of a nice or potential for a bit of capital appreciation in a kind of risk-off environment.
The higher yields you've spoken about need to be interpreted in the context of higher inflation in the UK, so currently at 3%. So what's your view for inflation this year?
I think for this year, I think inflation could be tricky. I think you're hearing it all the time with central bank commentary, where you really get the sense that they want to be cutting rates. You can see that they're worried about, in the UK, kind of with the national insurance changes, they're worried about kind of the growth slowing. But at the same time, wage inflation has remained sticky, and now you've got kind of the threat of tariffs pushing inflation up. We're almost back to this period where central banks are starting to justify inflation, high levels of inflation, as being transitory. We don't need to worry about them at the moment. I think it's something that markets were so scarred by recent years. I think the markets are going to be focused on the inflation numbers. So maybe it will be hard for governments to rally that much this year, unless economies really start to slow a lot more. Our view is probably isn't a risk in a higher inflation this year, but I think you have to put it in perspective. It's not the double-digit inflations that we had that caused the bond sell-off before. And even with inflation in the high 2, 3, if you've got 5 to 6% yields, that's actually not such a bad outcome, and a lot better than where we were.
You can also invest in gilts. So what percentage of the fund is in gilts, and is this a typical allocation?
At the moment, it is, when I say at the moment, I think with an actively managed portfolio, especially where duration is so much of a focus, it can change. So at the moment, as we're sitting here, it's probably 6 to 7% in gilts. A lot of that is in long-dated gilts. But if the rate environment changes or there's a lot of supply, it's something that we will trade around. Pre the 2000s, we had very little in gilts when the yields were as low as they were. We only really started adding duration to the portfolio. As always, I think with active managers, you're a bit early. But most of the duration that we added, we were building it into it pre the LDI sell-off, and then we took it up kind of during the LDI sell-off because the spreads widened. It gave us the opportunity to add credit risk as well as adding the duration. So at the moment, gilt position is about 6-7%, but it is a moving thing.
The actions of the Chancellor, Rachel Reeves, are very important for gilt pricing. So what's your view on the progress she's trying to make at the moment in terms of cutting the budget deficit?
How do I word this? I think if your argument or your basis of being overweight, being positive on duration, was on Rachel Reeves being able to reassure the markets, was the reason, I probably wouldn't have the duration. I think the reason for us to have the duration in the portfolio is because we think the UK economy is struggling, with the changes in national insurance, probably will continue to struggle. I think the government is in quite a difficult position with their fiscal rules. I think, and also the kind of the amount of supply we know. It's as we saw recently, the kind of the budget deficit's going up. I think they're going to keep trying to do what they can to not break their rules, but I think it is a challenging backdrop for the governments. But it's the same for all governments. Okay, the UK is quite often in the spotlight, and for obvious reasons, but wherever you look, whether it's the US or in Germany, there's a lot of government issuance everywhere.
And you prefer the longer dated gilts, so this duration element, their prices are going to rise more if interest rates fall. But why aren't you in the shorter end where you can lock in a fixed return, as we see a lot of our customers doing, buying bonds that would mature in 2 or 3 years' time?
Well, I think it's because it's a credit portfolio. So where we were chatting earlier about the breakdown of a portfolio, whether you have the credit risk or the interest rate risk, at the moment what you've got is credit spreads that are quite tight and credit curves are very flat. So when you're lending to a corporate, whether you're lending at 5 years or 30 year, the credit spread doesn't go up that much. But the interest rate curve, the front end is just a little over 4 and the long end's a little over 5.25. So the interest rate curve is a lot steeper and the credit curve's very flat. So what we've been doing is quite often having credit at the front end, because you're not getting, why take a 20-year corporate risk when it doesn't pay you that much more in spread terms than if you lend to a company for 5 years. But then having duration. So we use gilt futures as well. So we have long gilts and gilt futures as a way of taking the overall portfolio duration up.
And finally, the question we ask all of our guests: do you personally invest in your fund?
Well, I hope all the responses you get is yes, because I think it is important that fund managers invest in their own funds, and I always have done. In fact, actually, probably at the moment, given my view on kind of the relative attractiveness of sterling investment grade versus other asset classes, I probably have more invested in the fund than I ever have done.
Michael, thanks very much for coming in.
Thank you.
And that's all we've got time for today. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.